Now speaking, Ashish Kohli, Vice President, Investor Relations. Good morning everyone, thank you for joining us as we review GM's financial results for the second quarter of 2023. Our conference call materials are available on GM's Investor Relations website and we are broadcasting this call via webcast. Joining us today are Mary Barra, GM's Chair and CEO, Paul Jacobson, GM's Executive Vice President and CFO, and Kyle Vogt, CEO of Cruise. Dan Burse, President and CEO of GM Financial, will also join us for the Q&A portion of the call. We have had a strong quarter with revenue increasing by 8% year-over-year and net income increasing by 11%. We are also pleased to announce that we have launched several new initiatives, including a new electric vehicle platform and a partnership with Cruise to develop autonomous vehicles. We are confident that these initiatives will help us continue to grow our business and increase shareholder value. We look forward to discussing our results and answering any questions you may have. Now speaking, Mary Barra, Chairman and Chief Executive Officer. Good morning everyone. GM's operating results continue to demonstrate strong growth, thanks to an incredible customer response to our new trucks and SUVs around the world and strong execution of our business plan. We delivered $3.2 billion in EBIT adjusted in the second quarter, including an $800 million charge for new commercial agreements. We have now delivered 4 consecutive quarters of higher retail market share in the US and our total share was up almost 1 full point in the first half, with strong pricing and incentive discipline. We lead the US industry in both commercial and total fleet deliveries calendar year to date. We now have led the US industry in initial quality for the second year in a row. We are focused on strong cost discipline and we are taking additional steps to lower our capital spending. As a result, we are raising our full-year earnings, free cash flow, and EPS guidance for the second time this year. We now expect full-year EBIT adjusted earnings to be in the range of $12 billion to $14 billion. Adjusted automotive free cash flow is now expected to be up $1.5 billion in a range of $7 billion to $9 billion, and EPS is now expected to be in a range of $7.15 to $8.15 per share. We now expect capital spending in 2023 to be in the $11 billion to $12 billion range, which is about $1 billion less than the high end of our prior guidance. Our new vehicles are connecting with customers, with premium models accounting for more than 70% of sales for the new GMC Canyon midsize pickup and the Chevrolet Colorado's high-performance off-road models representing more than half of retail sales. The new Chevrolet Trax is also off to a very fast start and it's driving solidly profitable growth. We have now secured more than half of our 2030 direct sourcing target for many critical raw and processed materials we need with significant onshoring. We have identified another $1 billion in fixed costs that we will deliver over the same 2023 to 2024 timeframe, which means that relative to 2022, our automotive fixed costs will be down $2 billion on a net basis as we exit 24. We are investing significantly less capital in the next generation Chevrolet Bolt that we plan to execute and we will have more details to share soon. Lastly, Kyle will update you on the important steps Cruise has taken to scale its business and make it profitable. Now speaking, Kyle Vogt, Chief Executive Officer, Cruise. Thanks, Mary. Cruise is experiencing exponential growth driven by continuous improvement, engineering innovation and a solid product market fit. We have increased the supply of vehicles to 390 concurrent driverless AVs, which is the largest and fastest growing AV fleet in the world. We are confident in our regulatory and permitting paths and are already running in driverless mode on public roads in multiple cities. We are rapidly expanding cities, hours and service area, and plan to launch commercial service in 2 or 3 more cities in the next 12 weeks. Our product has over 85,000 5-star reviews in San Francisco alone and demand will greatly exceed supply for several years. Safety continues to improve despite increasing complexity, with AVs experiencing 54% fewer collisions than human drivers in similar environments. Our operational cost per mile traveled has gone down by an average of 15% per month for the last 6 months, and we expect cost to head below $1 per mile before the end of next year. We also have something else in the works that is highly disruptive to the AV industry. Cruise is no longer a science project, but a rapidly growing business with a transformational product in a multi-trillion-dollar TAM. Now speaking, Mary Barra, Chairman and Chief Executive Officer. I am proud to announce that negotiations with the UAW and Uniform have just kicked off. Our talented and experienced manufacturing workforce has a direct connection to our success, and we have a great future ahead of us. We are investing in strategic ICE vehicles, such as full-sized trucks, full-sized SUVs, and mid-sized SUVs. We are also retooling existing assembly plans and upscaling the team to rapidly grow in EVs. Our goal is to negotiate fair contracts with both unions that reward our employees and support our long-term success. This will be beneficial for our employees, plant communities, dealers, suppliers, and investors. We look forward to constructive talks. Now speaking, Paul Jacobson, Executive Vice President, Chief Financial Officer. Good morning everyone, thank you for joining us. We are pleased to report another quarter of strong results, with 4 consecutive quarters of year-over-year U.S. retail share growth and stable incentive spend. We have achieved $3.2 billion in EBIT adjusted, 7.2% EBIT adjusted margins and $1.91 in EPS diluted adjusted. We are raising guidance for the second time this year, driven by great products, successfully balancing supply with demand, and proactive cost management. We have made bold commitments, and to achieve them, we are focusing on a solid foundation. We are well along our way to achieving the $2 billion automotive fixed cost reduction, and are announcing an additional $1 billion fixed cost reduction to offset higher depreciation and amortization from our significant manufacturing investments. This expands the impact of the plan, with the only automotive fixed cost excluded being the lower pension income, a non-operating non-cash item. Revenue was up 25% year-over-year, driven by supply chain improvements and stable pricing. Wholesale volumes year-over-year were up 20% in Q2 and 12% year-to-date. We anticipate being toward the high end of our 5% to 10% guidance range for the full year. Adjusted auto free cash flow was $5.5 billion, up $4.1 billion year-over-year. We repurchased $500 million stock, retiring another $14 million shares, bringing the 2023 total to $865 million and 24 million shares retired. North America delivered Q2 EBIT adjusted of $3.2 billion, up $900 million year-over-year, and EBIT adjusted margins of 8.6%. GM International delivered Q2 EBIT adjusted of $250 million, largely flat year-over-year. GM Financial delivered EBT adjusted of over $750 million, down close to $350 million year-over-year. Corporate expenses were $350 million in the quarter, down $400 million year-over-year. Cruise expenses were $600 million in the quarter, up $50 million year-over-year. As a result, we are taking our full-year EBT adjusted guidance up to the $2.5 billion to $3 billion range. We are again increasing our full-year guidance to EBIT adjusted in the $12 billion to $14 billion range, EPS diluted adjusted to the $7.15 to $8.15 range, and adjusted automotive free cash flow in the $7 billion to $9 billion range. We are bringing the high end of our 2023 capital spend guidance down by $1 billion this year to the $11 billion to $12 billion range. We remain very well positioned for the future and achieving our medium and our long-term targets as we've highlighted. We are focusing on profitability, and our recent results demonstrate our not sacrificing margin for volume. We will continue this strategy with the decisions we're making today, helping to drive a fundamentally stronger company beyond 2023. Wolfe Research analyst Rod Lache inquired, what changes, if any, have you made to your mid-decade profitability plans based on recent EV pricing and cost trends? Mary Barra replied, thanks, Rod, for the question. We remain committed to achieving low to mid-single-digit margins for our EV portfolio by 2025. We're demonstrating cost discipline and winning with simplicity to drive efficiency and better serve consumers. We have a special team looking at how to reduce manufacturing costs, particularly in the body shop, and the battery team is working on reducing LTM costs. We intend to have industry-leading margins and have several levers to pull to get there. Paul Jacobson replied, pricing strategy has been a frequent topic of discussion on this call. We have seen strong and consistent demand for our vehicles, even as we ramp up production. This is likely due to the purpose-built EV that we created from the ground up, which has been well received by customers. Wolfe Research analyst Rod Lache inquired, have there been any changes to your mid-decade pricing expectations based on capacity growth and competitive actions? What is the $800 million LG charge and what cost savings does it represent? Mary Barra replied, we're committed to our 2025 EV profitability guidance and have taken steps to ensure we get there. We've taken a disciplined approach to pricing our vehicles, which has been met with positive feedback from customers. We also chose to do the right thing for our customers by investing $800 million beyond what a traditional recall expense would be. This has resulted in strong demand for our bolts, and we'll share more about our EV margins in November. Citi analyst Itay Michaeli inquired, can you provide an update on the automation equipment issue and when you expect it to be resolved? Are you still targeting $400,000 of cumulative volume by the first half of 2021? Mary Barra replied, yes, we are committed to our targets of 100,000 Ultium-based products in the second half of this year and 400,000 by mid-next year. We have seen improvements in the last 4 to 6 weeks with our suppliers' automation, but to ensure we meet our goals, we have added additional lines. I am confident in the teams we have in place and anticipate that production will be back on track by the end of the year, if not sooner. Citi analyst Itay Michaeli inquired, what is your outlook on US EV demand, given the focus on rising inventory? How do you view reservation orders as you ramp up Ultium products? What is your strategy for Silverado EV pricing in light of recent competitor action? Mary Barr replied, "Yes, I'm confident in the pricing of the Silverado EV. It offers a range of features and capabilities that make it a true truck, without any compromises or trade-offs. We have seen strong demand for the Silverado work truck and the RSD, which will be available from a retail perspective later this year." Citi analyst Itai Michele inquired, "What trends in EV demand are you seeing in reservations and how confident are you in your product performance over the next few months?" Mary Barr replied, "Yes, we are seeing strong demand for our Lyriq, Hummer truck and SUV, and Bolt vehicles. We have a list of customers who have already put down deposits and the churn rate is very low. We are confident in our product portfolio, pricing, and demand, and we are going as fast as we can to leverage the Ultium platform without compromising on quality." Goldman Sachs analyst Mark Delaney inquired, "What levers can GM use to sustain strong core automotive performance in the second half of the year?" Paul Jacobson replied, "Mark, thanks for the question. We're still being cautious in our approach to pricing and average transaction prices. Demand for our vehicles is strong and we've kept inventory consistent. We're focused on driving share with margin performance and have been pleased with the results. We're taking it day by day and as long as demand remains strong, we expect to continue performing well." Goldman Sachs analyst Mark Delaney inquired, "Can you elaborate on how Cruise is measuring the safety of its AVs relative to a human driver and what specific features are driving additional improvement?" Kyle Vogt replied, "Our data shows that our autonomous vehicles, AVs, have achieved a 50% reduction in collisions compared to a human benchmark established by a leading transportation research institute. When looking at collisions where the AV was the primary contributor, we saw 92% fewer collisions. Additionally, we saw 73% fewer collisions with meaningful risk of injury. These results demonstrate that our AVs are already providing significant safety improvements and we expect these improvements to continue as we invest in machine learning technologies." Bank of America Merrill Lynch analyst John Murphy inquired, "What is your outlook on pricing and margin expansion as you bring on more volume?" Paul Jacobson replied, "Yes, we've been able to maintain strong margins and inventory levels by balancing supply with demand. We've seen higher capacity utilization, yet inventory remains flat due to vehicles quickly turning over. This has allowed us to lean into pricing and outperform the industry in terms of incentives. We'll continue to monitor this strategy to ensure it continues to provide benefits." Bank of America Merrill Lynch analyst John Murphy inquired, "Would increasing volume require additional fixed costs?" Paul Jacobson replied, "Yes, our costs are mostly variable. We're seeing increased demand for higher trim levels on full-size trucks and SUVs, so we need to be mindful of the mix of vehicles we're producing. We strive to maintain a balanced approach to ensure our costs remain variable." Bank of America Merrill Lynch analyst John Murphy inquired, "How durable is fleet's performance in the face of economic risk, and is there pent-up demand that could sustain it even if rates rise?" Paul Jacobson replied, "Yes, John, you've got it. We've seen a lot of pent-up demand in the fleet sector due to the pandemic and semiconductor shortages. In the first half of 2021, our fleet business has been the strongest since 2007. We're seeing higher margins than before, which is great news for us. Our team is doing an excellent job and we anticipate this trend to continue in the near and medium term." Bank of America Merrill Lynch analyst John Murphy inquired, "Was the $792 charge for the LG issue contemplated in your initial guidance?" Paul Jacobson replied, "We anticipate raising our guidance for the year. We weren't expecting to do so at the start of the year." Bank of America Merrill Lynch analyst John Murphy inquired, "What is the impact of the $1 billion operating raise on the company's financials?" Paul Jacobson replied, "Yes, our business has continued to perform well. We expected to surpass the guidance we put out in the first quarter, and that's what we've seen through the second quarter and July month to date. Consumer demand has remained strong, which has been key to our success." Morgan Stanley analyst Adam Jonas inquired, "Are you using attributes of Ultium or a full ground-up Ultium platform for the new Bolt?" Mary Barr replied, "The new version of our product will be based on Ultium technology, which has enabled us to reduce costs by 40% compared to our second-generation battery technology. We are leveraging this technology to make our product more capital efficient and affordable for consumers. Our software-defined vehicle, Ultifi, will also ensure the latest features are available. We are confident that this will help drive profitability and consumer response." Morgan Stanley analyst Adam Jonas inquired, "Could GM consider using SAIC's EV platform to address the specific needs of the Chinese EV consumer? Is the strategy there Ultium only, or are you open to a potential use of another non-Ultium platform?" Mary Barr replied, "Adam, the Ultium platform is much more efficient than the dedicated platform. We have already seen that the dedicated platform was not cost-effective. We are continuing to reduce costs with Ultium and we are open to considering any cost-effective way to provide a vehicle that meets the performance needs of the Chinese consumer." Barclays analyst Dan Levy inquired, what factors are influencing the company's decision to reduce capex for 2023 and review the $11 billion to $13 billion for 2024 and 2025? Mary Barr replied, we are taking a proactive approach to ensure our portfolio entries are the right ones. We are leveraging existing capital and the Ultium platform to create the Bolt, and we are working on complexity reduction to reduce capital spending and vendor tooling costs. Mark Roos is leading this initiative with the marketing and manufacturing teams, and we are finding ways to take cost out of manufacturing and from a capital perspective. We are eliminating trims to reduce capital spending, especially on vendor tooling. Barclays analyst Dan Levy inquired, how should we think about the warranty expense associated with Ultium, given the unknowns of a new product? Is there a need for added conservatism, or is there data that shows the quality will be greater than the initial Bolt? Mary Barr replied, yes, the Bolt has been in the market for several years and has had good warranty performance. We experienced 2 specific manufacturing defects that caused an issue with the LGS process. Our team worked closely with them to understand what happened. We have implemented quality processes and error proofing at our Ultium plants to ensure that any issues can be quickly identified and addressed. We are confident that we will see strong warranty performance on these vehicles due to our use of General Motors manufacturing quality systems and processes. Evercore IC analyst Chris McNally inquired, Kyle, what is your estimated timeline for the 24/7 rollout of autonomous vehicles in San Francisco, and how many AVs would it take to provide a disruptive service similar to Uber? Kyle Vogt replied, good question. We are operating a significant portion of our fleet 24/7 for employees in San Francisco and are close to opening that up to the general public. We are ramping up manufacturing capacity to ensure we can gradually transition to a new form of mobility in the city. There are over 10,000 human ride-hail drivers in San Francisco, but they cannot work 20 hours a day like a robotaxi could. We believe there is capacity to absorb several thousand vehicles per city at minimum. Evercore IC analyst Chris McNally inquired, Mary, what are your thoughts on internal versus external funding for Cruise given the current environment? Mary Barr replied, we are generating sufficient free cash flow to fund Cruise's expansion. We will always prioritize what is in the best interest of our shareholders. RBC Capital Markets analyst Tom Narayan inquired, Mary, how do you view Ultra Cruise in terms of revenue and product enhancement? Mary Barr replied, we are pleased with the performance of our Level 2 Plus product, Super Cruise. We anticipate that it will continue to generate revenue and profits. We look forward to providing more information about this at our upcoming Investor Day in the fall. RBC Capital Markets analyst Tom Narayan inquired, could you provide some insight into how you are making the case for Cruise's safety features on a regulatory level, and is there a greater appeal now that the safety benefits are more evident? Mary Barr replied, I'm confident that our dialogue with the regulators is productive and that we are making progress in improving road safety. We have been sharing data with them for several years and have worked with outside groups to measure safety. We remain committed to continuing this dialogue and providing the necessary information to ensure that our roads are safe. JP Morgan Chase & Company analyst Ryan Brinkman inquired, what strategies are you implementing to increase profitability in China, particularly with regards to electrifying your high-end brands? Mary Barr replied, we have a strong portfolio of EVs for Cadillac and Buick that are being launched right now. We're working to ensure they meet customer needs and are efficient. Despite the 100 new EV entries, we currently have a high single-digit market share. We need to have the right EVs at the right price with the right technology to remain competitive. I recently conducted a full review of our product line and understand the competition. We have the right products coming and now need to go out and sell them. JP Morgan Chase & Company analyst Ryan Brinkman inquired, what has changed in the cost-sharing agreement between GM and LG for the Bolt charge? Mary Barr replied, we took the necessary steps to ensure our Bolt customers were taken care of during the recall. We worked with LGS to develop a diagnostic that would allow us to reduce the battery charge from 80% to full. We wanted to make sure we were providing the best service to our customers, so we took extra steps to replace the battery packs faster than necessary. We believe we took the right actions and have since moved past the issue. We are continuing to work with LG to improve our cost position. Mary Barr replied, thank you for your questions. Our success in the second quarter and first half is due to our new vehicles and strong execution of our business plan. We are investing in our optimized ICE and EV portfolio, growth opportunities, and cost discipline. At our upcoming Investor Day in mid-November, we will provide a detailed look at our software strategy, led by Mike Abbott from Apple. You will also have the opportunity to drive our new STBs and experience the capabilities of Super Cruise. Most importantly, you will get to drive the new Chevrolet Silverado EV work truck, which offers up to 40% more driving range, faster charging, and greater towing capability than competitors due to its purpose-built Ultium platform. We are going through growing pains now, but others will need to do the same when they reach their dedicated platform. We will continue to execute with discipline across all aspects of the business in Q3 and Q4. We look forward to seeing you in November and talking to most of you before then.